Wondering how to start your own private equity fund? Well, you've come to the right place. There are lots of reasons you might be considering going this route. Maybe you tried and failed to get a job in private equity. Maybe you tried and succeeded to get a job in PE, but now you want to do it yourself. You've heard how lucrative PE companies are, or maybe you want your hands on lots of companies. The list goes on and on. Either way, I'm going to walk you through the traditional steps that are necessary to start a private equity fund. It's not an easy or cheap process, so keep that in mind. But stay to the end and I'll share a cool shortcut that will help you get started faster and save a lot of money. All right, so let's dive into it. The first thing is lawyers. Don't you just love lawyers? Okay, so my advice here is get a good attorney. Bad attorneys are the most expensive things that you can pay for in this life, it feels like. So get a good one. Get somebody that actually does fund formation work. That's what you're looking for. So some of the top law firms out there for that are places like Cooley, Gunderson, Kirkland Ellis, Wilson Sonsini, and others. Here's what you don't want to do. You don't want to go to a smaller law firm that doesn't do this type of work. It's very specialized work. And the reason you want to do that is severalfold. So one, if you go to a fund that specializes in fund formation, even though their hourly rates will be really high, they have all of this templated, they do it all the time, and they're really fast. And so ultimately, even though you're paying more per hour, you'll pay a lot less in total. The other thing is that they'll know exactly what it takes and what the market is like for different terms. And so that you can make sure that you go out with your best foot forward when you're meeting with investors and you don't come with some wonky structure that they've never seen before. Like they'll be very comfortable with the structure that are laid out by these firms because it's what's the market, because these firms do it day in, day out. It'll also give you some credibility. If you're working with a Cooley, you're working with a Gunderson, investors know and respect those firms and will have a lot more confidence in you and your ability to fundraise. And then the last thing is if you go and work with a firm that doesn't have this expertise, part of the reason why it will be more expensive, even if you're paying less per hour, is that they will have to go out and learn on your dime. And that's like one of the most expensive ways to engage with lawyers is if you're paying them to learn how to do the law that they should already know. So go get a good fund formation attorney. And just for reference sake, you should plan on spending about $100,000 to set up the fund. Now, here's the nice thing. If you're successful in setting up the fund will pay you that money back. So if you're not successful, you will be out of the money. So keep that in mind as you're trying to think through whether or not you want to raise a fund, because you could be out significant amount of money if you're not successful. Okay, so the next step is that lawyers will help you draft what's called your PPM and your LPA. Now, your PPM stands for your private placement memorandum. And what it does is it tells investors what you will invest in and warns them of the crazy risk that it is to give you money, right? It'll detail all the ways in which they can lose money. It would also tell them like, hey, here's our strategy, here's who we are, here's the things we'll invest in, here's the things we won't invest in, and give them a general idea of what they can expect by investing in your fund. It's a marketing document at the end of the day that includes a bunch of risk disclosures. The other document is your LPA, and that's your limited partnership agreement. It is the defining document between you and your investors. It details how fees will be paid, how profits will be distributed, what happens if things go wrong on either side, what happens if an investor doesn't send in their money when you call capital, what happens if you make bad investments or you get hit by a bus or any of those kinds of things that could go wrong. The LPA details how those things get resolved. It is a super, super important document and actually represents the bulk of the work of what your attorneys will do. Typically what happens is your attorney will meet with you and they'll go through the LPA, the key terms, and they'll come with a template that they use for most people. They'll tweak the template based on your circumstance, and then they send it over to your investors. Your investors are going to have their attorneys, and they're going to go through that LPA line by line. They may have pushback for certain things. They'll want certain terms put in or taken out or whatever it might be. And that's ultimately where you end up spending the most amount of money with your attorney, is their attorney and your attorney going back and forth and negotiating out this document and hammering it and getting it solid. Once that's done, then you are ready to close. The way you close capital is essentially you are taking capital commitments. So you have what's called a subscription agreement. Investors will read through your limited partnership agreement, and if they agree with it, then they will sign your subscription agreement and subscribe to your fund. At that point, Once they've signed and then you've accepted the commitment, they are closed into your fund. All right. The other thing you need to do is you need to build a pitch deck. So your pitch deck should articulate your strategy, your team, your experience, and your track record. I will tell you, like, the most important thing in your pitch deck is your track record, and then after that, probably your strategy. If you don't have much of a track record, you're going to have to lean really heavy on your strategy and explain why your strategy is really unique and differentiated and why it will ultimately be successful. Your team is also important, super important, because they're the ones that are going to be operating the investment fund on a day-to-day basis. So getting your investors super comfortable with that is really important. Now, look, I've seen a lot of pitch decks over the years from different venture funds and private equity funds. I'll tell you, like, some of the most impressive decks were super short. They were like 5 slides long, and it was literally like title page, a page with their performance, which was incredible, and then like a page with like the team members, and then a contact page. That was it. That's all they had to do, and they closed billions of dollars into their fund. They're probably more the exception. On the other extreme, you've got funds that lay out across 50 slides a very detailed investment strategy, right? So depending on where you're at, think through your case, but at the end of the day, you've got to be able to convince investors that you can invest their money better than they can in order for them to trust you, and that you can be trusted with their money. And then once you've got your LPA hammered out and you've got your pitch deck, go out and pitch investors. If you have a track record that's strong, you might consider talking to what's called a placement agent. These are professional fundraisers for private equity, venture, hedge funds, and et cetera. And essentially what they do is they maintain a lot of relationships with different investors, family offices, endowments, sovereign wealth funds, high net worth individuals, school endowments, all kinds of different things. And they can be great at helping you get your foot in the door and meeting with those different funds and telling your story. So there are some downsides to working with a placement agent. They can be really expensive. And oftentimes they'll charge 1, maybe even 2 years of management fee for the money that they bring in, which can be pretty expensive because especially if you're a first-time fund manager, right, your fund typically is not going to be that big and you need every dollar in order to keep your fund operating. The other thing is placement agents won't take you on board unless they think that they can actually raise the money, because why would they waste their time if they're not confident that they're going to get paid at the end of the day, and they don't want to put crappy product in front of their network, so they tend to be really careful about that. But the flip side is if you have a strong network and you can get the placement agent to believe in you and you can work with them, oftentimes they can help accelerate your fundraise and connect you to people. When you get an investor that's interested, close them with the subscription documents as soon as you can. And once you have enough commitments, close the fund and start investing. I know people that their first fund, they were literally raising like $5,000 checks from friends and family, and they raised as much as they could, and then they went out and invested it, and they were able to build a little bit of a track record, and then they went back and said, hey, look at these great deals we've done, look at the great performance, give me a little bit more. And they were able to attract new investors and get more money from the investors that backed them in the first couple funds. And that just built and built and built and ballooned into, in some cases, billions of dollars under management. So that sounds super easy, right? Yeah, I know. It can be super tough, even for experienced professionals. You're basically telling people, like I said earlier, that you can do a better job investing their money than they can. And frankly, it's a tough sell, right? But if you don't have a track record, you can do what's called being a fundless sponsor. And many, many private equity investors get their start this way. What you do is hunt for a great deal, and then you pitch the deal to investors. Therefore, you're selling them not on you, you're selling them on the deal. And if you found a really great deal, they'll be excited to do the deal. Then you can take all those investors and put them in a single purpose vehicle, an SPV, which is just a legal entity where you consolidate all their money and make the investment. And then the SPV holds the stock. When the company gets acquired or goes public, you can sell the stock and then distribute returns back to your investors. That allows you to build a track record where you're able to show hopefully consistently over more than just one SPV, that you're able to generate great returns. And if you can do that consistently, then you have the ability to tell investors that, yeah, you can invest their money better than they can, right? And they should trust you with their resources and help you grow their assets. And in fact, you may decide that you don't even want to raise a fund and that you're happy being a fundless sponsor. And there are a bunch of groups that do that as well. The advantage with that is in a portfolio setting, you're going to get paid on your winners. And even though you won't get paid on your losers, those losers won't count against you on the ones where you do make money. So it can actually be a little bit better for fundless sponsors from a returns perspective. The flip side is every time you want to raise money, you have to go back out to all those investors and resell them on every single deal. The problem though, of course, is every time you want to make an investment, you have to go and fundraise for it, which can be really challenging. And if the market's moving really fast, it can almost be impossible to get into really good deals. The other benefit of an SPV is that the docs are way cheaper. It's not $100,000 to set up an SPV. You can use platforms like Assure, link in the description, if you want to learn more about what they do, to do all the legal work for you in an SPV for as little as $15,000 or less. You can also work with an attorney and set up your own SPV docs. There's a lot of different ways to save a lot of money in that arena. And the nice thing is your investors cover that cost as well. Hopefully this was helpful. Walkthrough of how to set up a private equity firm. Although it's not easy, this is the steps that pretty much everybody follows. If this was helpful, check out my next video where we're going to talk about how to get into venture capital without experience. Thanks.